Hey there, my name's Ben Everingham and I'm the director here at Pumped on Property, and in today's video I'm going to talk about why I'm so excited to buy a property in 2018, 19 and 20. So there's a lot of information out there on the internet. Take this one with a grain of salt, but I'm going to talk about sentiment over the next few years. I'm going to talk about money being a little bit harder to get, the Royal Banking Inquiry. I'm going to talk about prices and which marketplaces are set to do okay, which markets are going to decline a little. I'm going to talk about investors sitting on the fence. I'm also going to talk about my personal strategy for taking advantage of these next 2 to 3 years. I'm going to talk about the fact that I just don't care about short-term gains, and any smart investor looks at short-term buying opportunities as an average buy price, not as something to be fearful of. And then I'm going to talk about the Brisbane marketplace a tiny little bit, but I've got heaps of other videos about all of these different things online. In fact, between my YouTube channel, welcome if it's your first time here, please subscribe, and Ryan from On Property's channel, we've probably got over 500 videos for you to check out on all of the little ins and outs of the property industry. So my company, Pumped on Property, has bought over $200 million worth of property now in the last 3 years, and this is some of the insights that I've gained from being obsessive in the sense of I want to understand the cycle, I want to understand how to profit from it for myself and my clients, and I want to set myself and my family up with the most choices in the future to make great decisions. So the first thing I want to talk about is sentiment. I've talked about this in other videos before, but effectively negative sentiment has an effect on the economy, probably as much or more than anything else. Sentiment is effectively people's feelings of everything is good, it's going to be good forever, or everything is bad, it's going to be bad forever and it's never going to turn around, and it's the first time in history that it's ever been like blah blah blah. For anyone that's looked at Phil Anderson's book, The Secret Life of Real Estate and Banking, any of the core logic stuff, any of Fred Harrison's stuff, you will realize that there is a cycle in play. Sometimes it's easy to get money, sometimes money's cheap, sometimes it's harder. Sometimes people feel good about things when they should be really shit scared. Sometimes people feel bad about things when things actually look really good. And one of the announcements on Bloomberg last week was that 75% of the companies in the S&P 500, which is the top 500 firms in America, posted the best profits they have since pre-GFC. So I don't know if that's good news or bad news, but it means that people are making money, and that's why we got a bit of a run last week in the stock market over there in the last month. So sentiment has an effect on everything. Think about crypto, think about horse racing, think about watching the footy and your favourite team or the team that's doing well. You know, just ride the waves of it. I don't pay too much attention to it except when sentiment is really bad and the timing of the market's really bad. The second thing I wanted to talk about and touch on in terms of why I'm really excited over the next couple of years is that money's a little bit harder to get now than it was in 2015, especially early 2015, before APRA came in and made these amazing changes which had to happen to slow down the Sydney market and to get our banks' balance sheets back in a healthier position, because Australia's in a huge amount of debt, China's in some big debt, America's in some big debt, and one of the reasons why we came out of the last GFC so smoothly was because we had a surplus from a very, very well-run government financially, which was the Howard government, to get us in a position so that when shit did hit the fan, the Rudd government could go and put us in massive debt and get us out of it. But I just wish we actually had have gone through the recession the same as the rest of the world, because now we're in huge debt and we might not have needed to have been if we hadn't have stuffed around with that, even though it would have hurt a lot of people, myself included, at that time. So money's harder. When money's harder to get, less people can get money, which means people like you and me that have some money can buy stuff at prices a little bit cheaper than they would have been if everyone was in there and everyone was buying at the same time. So I love it when money's a bit harder to get, because if you're earning $100,000 per year and you've got your own home with a bit of equity in it, or you're a first timer earning some okay money, $50,000, $60,000, and you've got a nice deposit there, you are in a great position to take advantage of things when other people stop buying. You know, that is the time to buy, according to Warren Buffett. Now, I'm not saying everyone should go out and buy property between 2018 and 20. You know, it's got to be the right strategy, which I'll touch on in a moment. So, you know, it's not about going and buying the top of the market in Sydney and Melbourne. It's being about being very, very, very specific about which markets you're targeting, which product types you're targeting, chasing cash flow, realizing that things may sit flat for a period of time before they get out of control again after sort of 2019-20. So interesting information for those of you who love the data like me. Now, the third thing is why I'm excited in the next couple of years is that certain markets are going to go into a phase of decline. Certain markets are going to be hurt more than others. Now, Brisbane has been flat for 10 years. In fact, when you factor in inflation, it's cheaper to buy here than it was 10 years ago in most suburbs. Not all suburbs. Some suburbs have gone up by 80%, the same as Sydney and Melbourne in the last 10 years, but others have done nothing. Sydney and Melbourne, on the other hand, have gone through 70 to 80% growth. And if you look at the Heron Todd White report, Melbourne's at top of market, which I called a year ago. It would be exactly here by now. Sydney is, which I called 2.5 years ago, is now in a phase of decline, and prices have come off by about 5% in Sydney, about 3% in Melbourne. I'd love to see them continue to slide to over the next 3 years, somewhere between an overall 5% to 15 or 20% decline would be amazing, just to sort of reset that crazy speculation that has happened in those markets in the last couple of years between 2016 and mid-17. So, you know, if you're one of those people that own down there, don't fret about a 5 to 15% decline when you've just made 80% in the last 5 years or 6 years. You're still 65% up or 75% up. You're still in a good position, and prices over the long term in those markets with 100,000 people moving into them per year are still going to look fantastic. So prices may decline. Who gives a shit about what happens in 1 year or 2 years? If you are interested in short-term gains, go and listen to someone else online that is all about getting rich quick. But if you're interested like me in choices in your future, financial stability in terms of passive income for life without taking on huge amounts of risk and debt, then your strategy is already a 15 to 25 year one, and what happens in the next 1 to 2 years might just be the buying opportunity that you need anyway. So the fourth thing I wanted to touch on is some investors are already sitting on the fence. More investors are going to continue to sit in the fence, particularly as the Sunday Telegraph puts out more awesome information over the next couple of years based on sound historical research, I'm sure, about why this is the worst time in history to buy property in Sydney or Melbourne. Looks a lot like what might have been written on those papers coming up to this phase in 2000, or before that 1990, or before that 7 years, and before that 7 years, and blah, blah, blah. It's like literally the same story that has been told for so long. I would be avoiding those markets personally. I don't see any value down there until 2020 at least. Possibly even a lot longer than that, but I don't want to call that on this video. Other marketplaces like Brisbane, some of the other regional markets and metro markets around the country that haven't performed well in the last 10 years look really interesting to me for the last 7 years if history is going to repeat. It has been repeating in Australia for about 100 years now in terms of the cycle. The US for 250 years, Europe for 300 years. So let's see what happens there. But some people sitting on the fence means more stock on market, more quality stock, more sellers, slightly more affordable prices, particularly the top end of the market over that sort of 500k mark in Brisbane, over that $2, $3, $4 million mark in Sydney and Melbourne, possibly, where some of those prices have already come back by 200 to 500k at the very top of those markets already. So strategy is the most important thing with all this stuff. Don't get caught up in my talking, anybody else's talking. Get to the source of the data, which I've talked about in other videos. I actually just recorded another video which is interesting, titled "What is the Mid-Cycle Slowdown?" and I'm about to record another video and release it titled "The 18 to 19 Year Property Cycle Explained." So don't stick your head in the sand and go, everything's bad because the telly or current affair told me about it. Really understand the data and which markets are in positions to take advantage of that and which markets you should avoid right now, at least for the next few years. So my strategy is so simple, and it's just based on looking at Heron Todd White, CoreLogic, Residex, Michael Matusik, Fred Harrison, Phil Anderson, and a bunch of other resources, and basically I pull in little snippets of information, and what I've found is some rules that seem to work over the longer term. Who knows what the hell's going to happen in the next 1 to 2 years, and who really cares as long as you're not completely over leveraged and in a poor financial position. There's so many of you that would be watching this that have good equity in your home, good jobs, good savings, or maybe you're starting out, or maybe you've got good equity across some other properties. You know, the strategy for me is simple. Take advantage of market timing. Timing right now, according to Heron Todd White, looks very, very interesting for Brisbane. I would never personally buy outside of Brisbane, Sydney or Melbourne, or the major markets that surround them, because you're rolling the dice and hotspotting and hoping that it performs well. My strategy actually is Sydney, Melbourne, Brisbane at the right time of the cycle. I bought a lot of property in Sydney in the last GFC, or just as that was coming to an end. I've sold a lot of property there in 2017 at the top. I'm reinvesting that money into Brisbane now, and you know, we'll hold some of that stuff and we'll probably sell some of it around 2024, when I think Brisbane will be in a nice position like Sydney was in 17 to make some money. My strategy though for the properties that I hold long term, which is the most important thing, because I want cash flow coming in for life regardless of booms or busts. So cash flow is number one. Ryan, you've got to come and put your head into this video quickly, bro. Ryan from On Properties just walked in to the office looking like he's got some swagger today.
Dude, I nearly bought that jumper today. Is that from Cotton On?
No, this is from Roger David.
Yeah, there's one at Cotton On that looked just like that. I seriously nearly bought it this morning. No joke, we would have been wearing the same thing.
I'll see you in a sec, bro. I'm just going to finish off this little one. Ryan walking in, celebrity in this property world, guys. But my strategy is simple. Cash flow always. I'm looking for at least 6 to 7 or 8% rental returns, which are achievable right now in Brisbane with buying a house and adding a granny flat within 20 k's of the city. That's right, you can buy properties for 400k in Brisbane, 20 k's from the city still. Long-term gains. So when I was younger, it was all about getting rich quick and getting financially independent. Now it is about setting myself and my family up and making great long-term decisions over the next 10, 15, 20 years. Timing, which I've been harping on with the last 500 videos I've recorded. If you don't understand timing, read Phil Anderson's book, The Secret Life of Real Estate and Banking. Have a look at the Heron Todd White. Get your head around that stuff. It's important. Timing is absolutely where you make 80% of your money as an investor, whether you're developing, holding long term, or going for cash flow. It's all the same thing. I only buy houses because the data, according to Michael Matusik and CoreLogic, looks like it supports houses to outperform units over the long term. Buying close to the city and close to the beaches, close to the cities is all I'll ever do again. After looking into that data from the Australian Bureau of Stats, Michael Matusik and CoreLogic, you'd be a mug if you're investing outside of that. And then Brisbane, Sydney and Melbourne, based on the last 50 years, have smashed the performance of everywhere else in Australia. So they're the markets. They're also the markets that are going to get 75% of the growth. So if you would ask me where am I buying for myself in the next 3 years, 18, 19, 20. Brisbane, I'm taking advantage of 10 years of flat growth in a market that's got really good population growth right now, really, really good job growth right now. That's what I'm personally doing now. I wanted to finish on two little things, and these are more just rant things. The first is I don't give a shit about short-term gains. So if you're one of those guys that's like, I'll sit on the fence for a year and see how things go, like you've just missed the point. Like whether prices are 5% more expensive in a year, 5% cheaper in a year, or the same as they were in a year, I just don't care. What I care about is an average annual growth rate over the next 15 to 25 years of somewhere between 4% and 5% per annum, which I am hoping that I'll get in Sydney, Melbourne and Brisbane, but I can't guarantee that. So I just don't care, and my strategy is so much orientated around buying well, buying at the right time, getting long-term capital growth and getting great rental returns, with a focus at the moment on rental returns to set up good cash flow for life and to put my family and myself in a position where we've got choices is absolutely powerful. So that's where my head's at. Take it with a grain of salt, I don't know, but based on researching this stuff like a madman now for 8 years. You know, there's a method to the madness sometimes as well. Last thing I want to touch on, I've done heaps of other videos on Brisbane, go and have a look at those, but I like Brisbane because I can get 7% rental returns within 20 to 25 k's from the city. I can buy waterfront property in Brisbane or in waterfront suburbs for 500k walking distance to the beach. I can buy really high quality houses in amazing suburbs 10 k's from the city for 550k. I can add granny flats in all 3 of those areas and achieve 7% yields. I love Brisbane because long term it's done so well, but in the last 10 years it's done absolutely horribly. I like Brisbane because more Australians are moving to southeast Queensland than anywhere else in Australia in 2017 and 18. I like Brisbane because CoreLogic said that the average household income in Brisbane is now higher than the average household income in Melbourne as of 2018. I like that if I look at SEEK, construction and engineering related jobs in the mining industry, and posting for those jobs are up 67% year on year. And a friend of mine who's a client just told me that there's 3,000 new jobs being created in the last month by one of the big mining companies in Brisbane, which means interesting commodity prices and times might be back. And a lot of those guys, a lot of our clients are in the mining industry, say that some stuff might be starting to heat up a little bit again, in a good way, you know, in terms of more jobs being created, more high paying jobs being created. I just like where it's at. I like to buy cheap, like I was buying in Sydney in 2011 to 2013. After Sydney had been flat for 9 years, now Brisbane's been flat for 10 years. I'm buying here. When Brisbane tops out, I'll hopefully be looking at Sydney and Melbourne again, because timing will look better for them again. So get your head around this stuff. It's lots of fun. This is just my opinion. Take it with a grain of salt, obviously. I'm excited about the next couple of years. Like, bring it on. Generally, the worse the story gets in the media, the better the story gets for me as an investor, and as someone who understands the market and understands how to leverage sentiment to buy very, very well. Some big buying opportunities coming up to set you up really nicely for 2020 to 24, when I think prices are going to go in a direction more similar to what we've seen between 2013 and 17. So good luck with your journey. Take it all with a grain of salt. I don't know. I don't have a crystal ball. I can't predict the future. I'm going to go hang out with Ryan for a while. We've got like a massive day planned. Have a good one. Thanks for your time and your attention, and good luck over the next couple of years. Take advantage. Bye.